This is not just another news day. Today, we've witnessed massive shifts in global financial momentum. Something big is brewing, and if you want to stay ahead, now is the moment to tune in. While most people are distracted by the 4th of July fireworks, the markets are already lighting up in ways that could impact your wealth, your investments, and even your career. So grab your focus, because this isn't just another update, it's your daily advantage. Bitcoin spiked early today, briefly crossing the $110,000 mark after a surprisingly strong U.S. jobs report. Traders were optimistic, thinking strong labor numbers would calm fears of recession. But just hours later, prices reversed course, falling back to around $107,800 as new concerns around impending trade tariffs stole the spotlight. Risk appetite faded as news spread that the U.S. would begin sending tariff letters to several trade partners starting today. The fear of 10% to 70% tariff hikes has thrown a shadow over the crypto rally, with Ethereum and Solana following suit in the red. While crypto traders felt the chill, Wall Street was enjoying a rare moment of calm. Though markets were closed for the national holiday, the futures market told a different story. S&P, Dow, and Nasdaq futures dipped around 0.7%, a cautious move reflecting underlying tension. Investors are aware that the 90-day tariff pause ends in just 5 days, and what comes next could either bolster or break this bullish momentum. Many are holding their breath, watching for policy signals, while volume remains low due to the July 4th break. Despite the cautious tone, America's major indices remain impressively strong. In fact, the S&P and Nasdaq just posted multiple record highs earlier this week. AI stocks are continuing to surge, driven by relentless enthusiasm around tech and automation. NVIDIA in particular is a name to watch. It's carrying the entire chip sector on its back and giving momentum to related ETFs. Even with global uncertainties, U.S. equities seem to be surfing on optimism, and that momentum shouldn't be underestimated. Globally, the mood is more fragile. Asian markets closed mostly lower. South Korea's Kospi dropped by 2%. Hong Kong's Hang Seng lost 0.6%, and Japan's Nikkei finished flat. European indices didn't fare better. Germany's DAX declined, France's CAC slipped, and the UK's FT was in the red. Investors are jittery about how US protectionist policies might ripple across international trade channels. In short, global risk appetite is being challenged just as the US flexes its economic muscle.
Commodities took a small hit too, with oil futures dropping 1.3% and copper sliding by 1.6%. These declines reflect both thin trading volumes and renewed concerns over potential disruptions to supply chains if tariffs are implemented aggressively. Interestingly, gold edged up slightly, acting as a safe haven amid mounting uncertainty. It's worth noting that gold has quietly outperformed even Bitcoin year to date, with a gain of over 26%. It's a strong signal of growing demand for stability. The bond market showed its own anxieties. Treasury yields swung back and forth after the release of stronger than expected employment numbers. The June payroll report beat expectations, adding 147,000 jobs versus the forecasted 111,000. However, wage growth was modest, and the unemployment rate ticked down to 4.1%, complicating expectations for the Fed's next move. Rate futures show that hopes for a July interest rate cut are fading, while a September cut remains more likely. Crypto derivatives traders were busy today as nearly $3 billion in Bitcoin options and over $600 million in Ethereum options expired. This expiration event paired with macro volatility added fuel to the price swings in the digital asset space. As institutional investors recalibrate their portfolios for Q3, analysts are watching to see whether open interest will rise again or flatten out. Many expect the market to enter a new consolidation phase before a decisive breakout in late July. The dormant Bitcoin whale wallet that activated yesterday continues to draw speculation. Transferring 10,000 BTC worth over $1 billion, this wallet had been inactive for 14 years. Analysts observed that none of the funds were sent to exchanges, suggesting it wasn't a sell-off move, but perhaps strategic repositioning. Such movements always spark fear of dumping, but long-term holders often view them as a reminder of Bitcoin's long history and silent accumulation. Volatility in the crypto space has actually decreased over the past month, despite the noise. Implied volatility for both Bitcoin and Ethereum is trending downward, hinting that traders expect stability or are waiting for a breakout. This contrasts with the broader market fear and shows that crypto is becoming more mature. At the same time, it's becoming more correlated with traditional equities, meaning macro events matter more than ever before. Meanwhile, the Biden-Trump fiscal debate has reached a crescendo with the passing of the $5 trillion debt package. While it's designed to stimulate growth and defense, concerns over its impact on inflation and deficits are valid. Some economists believe this fiscal injection could accelerate economic activity in Q3 and Q4, but at what cost? The bond market is already showing stress, and Treasury auctions next week will be closely watched for appetite.
Stablecoins have come under scrutiny again. JP Morgan released a report slashing their projection for stablecoin market growth from 1 trillion to just 500 billion by 2028. The reason? Lack of real-world utility. While stablecoins remain popular for trading, only a small portion is used for actual payments, and regulators are still slow to provide clarity. The result is growing skepticism from institutional investors. In the regulatory sphere, Congress has dubbed this week Crypto Week with 3 proposed bills on digital asset regulation. These proposals could radically change how exchanges operate and how stablecoins are governed. Simultaneously, the government's initiative to build a strategic Bitcoin reserve is gaining traction. Currently, the U.S. Treasury holds around 200,000 BTC, signaling a profound shift in how the federal government treats digital assets. On the global policy side, central banks are becoming more vocal. A new survey of global reserve managers shows deepening skepticism toward U.S. monetary independence. Around 29% of them plan to reduce their dollar holdings over the next 12 months. Gold is the primary beneficiary, with over half planning to increase exposure. This marks a potential pivot away from the dollar-centric reserve system. The energy and automotive sectors saw a policy twist today. European automakers have reportedly asked for exemptions from new U.S. tariffs, offering to boost American production in exchange. Talks are underway with the Commerce Department and, if successful, could avert a significant cost increase for electric vehicles. This development is key for both trade diplomacy and EV market dynamics. Tesla, however, continues to face headwinds. Its June delivery numbers fell short, partly due to the removal of tax incentives under the new fiscal package. Shares dipped slightly in pre-market futures, and analysts are revising Q3 projections downward. While long-term faith in Tesla remains strong, competition in the EV sector is tightening, new players gaining traction globally. A quieter but significant shift is occurring in the DeFi sector. Leading protocols are reporting lower user activity but higher TVL, total value locked, suggesting that large investors are consolidating positions rather than exiting. This quiet whale activity could set the stage for a stealth rally in Q3. Keep your eyes on Layer 2 networks and cross-chain platforms. They're quietly positioning themselves for mass adoption. Real estate remains a bright spot in the U.S. economy. Despite rising rates, demand for suburban properties continues to grow, especially in Texas, Florida, and Arizona. Institutional investors are pouring money into rental housing, betting on demographic shifts. While prices have cooled slightly, rent inflation remains a concern, pushing more capital into real assets. Looking ahead, the key themes for the next week will be the July 9 tariff deadline, second quarter earnings previews, and any fresh guidance from the Federal Reserve. Markets remain sensitive to geopolitical headlines, and summer volatility may rise as liquidity thins. For investors, this is a time to watch carefully, plan methodically, and act with conviction, not emotion. So if you've made it this far, you now understand the financial battlefield of July 4th, 2025. The opportunities are real, the risks are present, and your ability to adapt is your greatest weapon. If this video helped clarify the chaos, smash that like button, subscribe to the channel, and leave a comment sharing your market strategy. This isn't just a video, it's a community, and we're all in this together.